Hey, Craig Scott from Wealth Minus Wall Street. Thanks for joining us today. Today, we're going to talk about how to rescue your retirement with real estate. We call this a retirement income accelerator. Many people that we speak with feel that they're a little bit behind in their retirement savings, and they're looking for strategies to really beef up the amount of income that they can generate in retirement. And we think one of the best solutions out there is buying real estate, but buying it in a very specific way that we're going to share with you. We're going to show you why it complements other retirement assets that you may have. Um, so before we get going and talk about that, let me just quickly introduce myself. My name is Craig Scott. I was a financial advisor for over 25 years, have firsthand experience of how Wall Street works. I've worked for some of the biggest financial institutions out there. I've had my own financial advisory firms, so I've seen it all. I came to the conclusion that the business model, it's really biased and outdated. A lot's changed in the last 20 years, but the Wall Street business model hasn't changed. And the only thing that it has changed is it's actually perfected how it can maximize the amount of fees that it charges its clients and many times hides those fees from them. So I wanted to give you a peek behind the curtain, show you exactly how Wall Street works, explain to you how it's not always in your best interest, and more importantly, give you the tools and the information to help you turn the tables, make sure your best interest is being served, make sure all recommendations benefit you before the financial institutions. And that's really what we're trying to do here at Wealth Minus Wall Street. The ultimate goal is creating financial freedom, giving you access to the best information and partnering with us to where we can help you navigate what can be a very confusing topic and industry. Everything we're going to talk about today is for informational purposes only. Do not construe this as investment tax advice. Feel free to contact your financial professional, tax professional, if you are looking at making any purchase decisions. So let's look at the retirement hourglass. This is how Wall Street views retirement. So picture you putting an hourglass down, and what do you see? You see the sand going from top to bottom. Right? You see that top getting smaller and smaller. And that's really retirement planning. Your assets are the top, and in the bottom, it's the income that you need. So what you see and what you spend your time doing in retirement, and I've seen it, I've helped hundreds and hundreds of people in retirement planning. This is what they do. You watch your account value, and it's typical of watching the sand slip through the hourglass. You're worried about, oh, is this shrinking too much? Is the money going to last? It creates a lot of stress and anxiety. What we want to do is we want to get out of that hourglass model, and we think the focus should be more on income and less on pulling out assets to cover the income. Because believe it or not, they're two different strategies, and we're going to do a little bit more of that today. So here's the problem that we see. Retirement is an income problem. You need income. You need to replace income. You're used to getting a paycheck for 30, 40, 50 years. All of a sudden you retire. How do you replace that paycheck? Well, Wall Street wants to solve an income problem with asset growth. Well, why would they do that? Right? Who benefits from that? Isn't it common sense? You need income? Well, yeah, it is. The problem though is Wall Street makes so much money off asset growth. That's what they focus on. And that means that this isn't necessarily in your best interest for you or your family. So as we mentioned at the top, right, real estate is very underutilized when it comes to retirement planning and creating income for retirement. There's a very logical reason for that. The first side of the equation is financial advisors don't want you buying real estate because they want you buying what they sell, which is Wall Street assets, Wall Street investments. So they might talk you out of it. They might tell you how difficult it is. You can have vacancies, you can have all these repairs, blah, blah, blah. Well, at the end of the day, it's just because it's going to reduce the amount of income. And realtors on the other side, that's who you would go to maybe to do these transactions. They're not trained in retirement planning and tax planning, right? That's not really their job. That's not their role. That's fine. But that gap is real. And what we've done at Wealth Minus Wall Street is we have solved that gap. We have our real estate license. A lot of what we do centers around building retirement income through real estate, as well as understanding how Wall Street works. So we're in a unique position to talk uh, about how real estate could fit into your overall retirement. So here's the unique thing about real estate. It's really the only investment right now that checks both boxes when you look at what do you want to do when you get an investment. Right? Usually it's either you want it to grow or you want it to produce income. It's hard to find both. Growth is your stocks. Just say income's like your bonds. Real estate's doing both. Right? Real estate is competing from a return standpoint with stocks, but it's also producing more income than bonds are right now. And we would argue that income's actually a lot safer than where bonds are right. This just speaks to the growth component. These two charts, the red is a Case-Shiller Home Index, and the blue is the overall US stock market. And what you can see, pretty much a dead heat, right? The red's a little bit higher, done a little bit better. But at the end of the day, what we're just trying to convey here is you're still capturing growth. Your asset can appreciate, but also you're generating great income right now compared to where bonds are. So here's some benefits of real estate today, right? We know we had a pretty miserable year last year in 2022. We've had a good start to the year for the stock market. Will that last? There's a lot of issues underlying with the economy. So you always have to worry about how much risk are you taking in those investments. Better income potential today, and also most likely in retirement. As we said, income is so important. Real estate is very tax efficient. A lot of CPAs don't understand this either. There's great tax efficiency in real estate. The advantages that you get without even knowing it forces you to stay in the market, right? So the problem with stocks and bonds is it's too easy to get out, right? You can press a button, you can call your advisor. Real estate's a little bit difficult. Most people don't view real estate as a day-to-day, oh my gosh, the real estate market's soft, I should sell the house. So it actually forces you psychologically to stay invested. And that's why at the end of the day, you'll end up having some pretty good returns. It's a great inflation hedge. That's the other one knock on bonds. Not only does it increase the income that you can get from bonds, but also it's a better inflation hedge than bonds are. I say fairly recession proof. There's a couple areas of the real estate market that we focus on that are recession proof. It creates real diversification. We'll get into that in a little bit. Wall Street preaches diversification, but you're diversified on what they sell. You're not really diversified. And also you can buy real estate in an IRA. Most people don't realize that. Again, advisors don't want you to know that because how you buy real estate in IRA, the big financial institutions don't let you do that. It's something that they really don't want you to do. So I think it's smart always where we take a look at what are the biggest, wealthiest financial institutions, people, what are they buying? What are they doing? And we're seeing Blackstone, Goldman, they're buying single family homes by the billions. Okay, so if they're doing it, it should have us take a little bit harder look and say, well, why are they doing that? Should we be doing it? And we're going to make the case that you should do it. This is just an example of how the wealthy institutions, endowments, big financial institutions, how do they invest versus how you and I invest typically? Well, what we've seen is the average investor, just the individual investor, they only have about 5% of their assets in what's called alternatives, where large financial institutions have anywhere from 30 to 60% of their allocations outside of the typical Wall Street market that we think of. Here's the benefit. So I know this is a busy slide, but the blue line just means that you're getting more return with slightly less risk if you incorporate 20% of your portfolio into what they deem alternatives. Alternatives can be hedge funds, can be private real estate, can be a lot of things. For our purposes here, we're just going to talk about private real estate, but it does exactly what you would hope to do with diversification. It increases return, decreases risk. We talk, especially for people who are building wealth, we always have a conversation. The dollars always go to the 401k IRA because that's conventional wisdom, that's status quo, that's what you've been told. And again, that's not a bad thing, but it's not the full story, right? So here's some advantages that real estate has to 401k investing. Your money's not locked up till 59 and a half. Okay. We think that's very, very important. So it gives you more liquidity. You have the use of leverage, right? So if you finance, you get more bang for your buck, if you will. You only have to put a down payment down, and now your asset, you have more an asset. The potential for higher tax deductions, if you do it in the right way, higher income potential, tax deferred growth, which is really important because you can do what's called a 1031 exchange if you want to swap properties and get a different property. There's higher contribution limits with the tax deduction. We'll explain that. There's the potential for a tax-free death benefit if you leave it to your heirs, beneficiaries. It gets you out of stock market risk, bond market risk as well, and you maximize your retirement income potential. We talk about diversification. Does diversification do what Wall Street tells you, which is protect you from major downturns? This is going back to 08, 09, actually 07, which is kind of when the market peaked. And this is an example of a T. Rowe Price asset allocation type of fund, right? So you had a little bit of everything. You had bond stocks. You were diversified, what they tell you. You still lost 56%. Similar investment last year lost 25%. So we've seen that diversification is not effective most of the time when the markets go south. Here's why this is important. So when you lose a lot of money, there's what's called a sequencing of returns. So when you lose money based on when you retire has a very big impact on if your money will last or not. So this is just two people, one retired in 2000, one in 2010. They both invested their money in the S&P 500 and they both took out $30,000 a year. Now, if you remember, the 2000s was a pretty challenging year in the market. The first 3 years were negative. And then you had the big down year in 08. Well, at the end of that decade, this person would only have $138,000. They're taking 30,000 out. They're going to run out of money. It's just a matter of when do they run out of money. Now take a look at 2010. You didn't have down years until 2018. So your money was growing for those first handful of years. And what did that mean? That was $1.1 million. The flip of a coin. Right? You have no idea what was going to happen. Advisors have no idea what was going to happen. So that's what we talk about when we want you to really reassess how you think about risk, right? Because you're taking a lot of risk just putting your money in the markets because you have no idea when those downturns are going to come. So this is why we think being diversified is you want money outside of Wall Street to help protect you just in case there's major stock market. So as we said, real estate, it probably is the most tax advantage asset. The wealthy use it for that reason. You can get huge tax deductions while you own the property. We're going to go on that in a second. You have the ability to defer gains when you sell. I told you that's that 1031. The proceeds are capital gains, not ordinary income. So like versus an IRA, when you take money out, that's ordinary income. If you sell a property, it's capital gains. Capital gains typically is lower than ordinary income. And again, you do have the ability to transfer tax-free. I say tax-free because you can get what's called a step-up in basis should you pass. So there's a lot of ways that you can navigate the tax code with real estate. So here's what we really try to accomplish. We want to see, how can we cash flow paid off in retirement? So we want to do it. We want a tax strategy to create tax-free rental income while you're working, so you get the benefits of that deduction. You want to take advantage of creating a real estate business. Right. So a lot of you who work for an employer, you're a W-2. So you're limited in what you can write off. Well, you start buying real estate, that's a business. So now you can write off lunches and miles and, meeting with realtors, things like that. So there's tax advantages there to even invest this way, again, while you're working. At some point now we're going to shift and we want to get this thing paid off. We want to pay down that mortgage by the time you retire. If you're retiring 10, 15 years out, we want to get a note at some point that's 10 to 15 years. Because the ultimate goal is when you retire, we want this thing paid off so it maximizes your retirement cash flow, right? That's at the end of the day what we're trying to do for retirement is maximize the amount of income you can generate. So here are some ways where you can get a six-figure deduction, okay? Most of the time, you're only able to deduct losses from gains. And real estate is typically deemed passive. So any losses that you get from your rental business, you can only offset that to the gains that you generated. Okay. But there's three ways that you can change this. And if you qualify for one of these three ways, you can get a huge tax deduction against your W-2 income, your business income, if you qualify. This loophole is being phased out over 4 years. So right now, you only get 80% of the benefit in the year that you implement it. Next year, you're only going to get 60% of the benefit, 40%, and it's getting phased out over the next couple of years. So it's a great way to take these huge deductions. We just did one for a client who got 120,000 tax deduction. We're about to finish off another client. He's getting about 90,000. Both of them are W-2 employees, and they're writing that off against their income. So it's a very powerful, powerful tax tool that you need to be aware of. When you schedule some time with us to have an initial conversation, we'll go into more detail and show you how you can qualify for these three different formats. Let's just go back now to the income generation versus the S&P 500. So let's assume you had $200,000. You invested in that in the S&P in 2000. And you put $50,000 down on 4 rental properties, right? So same out of pocket, $200,000, and you finance these rental properties for 15 years. So they were completely paid off in the 15 years out. So at the end of that 15 years, the S&P would have grown to 358,000, and now you're sitting on 4 homes that are fully paid off. We don't even care about the appreciation in this scenario because we want to talk about income. They most likely appreciated. And even if they didn't appreciate, it's $1 million, right? Because they put 20% down in each of these examples. So $50,000 per house, you had $1 million in real estate after 15 years, assuming no appreciation. Well, now what can you do with that income? So in your retirement accounts, the old rule of thumb used to be 4%. So they called it the 4% rule. So you could take 4% out, and by doing that, your money would last, good amount of time. You could feel confident the money's going to be there. Well, because of the type of economy we're in with inflation, interest rates, it's been ratcheted down. Morningstar, a very popular company, came out and said, we think it should be 2.8% now, which is a huge difference in income. And in this example, they're saying that you actually need 43% more in savings to make up for that difference between 2.8 and 4. It's a big, big number, 40% more. So same example. Here's the income that was generated. And again, this is an actual example for a client of mine that bought some properties here in New Jersey, and what he's projecting for income based on getting these things paid off in 15 years. So 2.8% of that 358,000, 10 grand versus $105,000 projected in these 4 retirement properties. So you're at 10 to 1. So let's just say you had $1 million. You paid cash, make life easy. Again, that 2.8, 28,000 versus 105, right? So now you're at 4 to 1. Oh, and by the way, if you did it this way, the way we appreciate this, you'd have tax-free income for 3 or 4 years. So that 100,000 would be tax-free. But here's the thing, right? We talked about how important investment performance is. So the average investor through 2021, this even through 2022 was a bad year, did about 2.88% in equities. This is from a company called Dalbar, who studies investment returns. So 2.88%, very, very, very small number. And that's what a lot of people got over the last 20 years, whether you realize it. And this is interesting. So this is kind of the peeking behind the curtain that we had talked about. So this was a quote from Richard Bernstein, who was a former chief investment strategist at Merrill Lynch. And he basically said, what's shocking is that simply by investing, most people actually made themselves poor. They're just shooting themselves in the foot over and over. Basically what he's saying is, if investors make the wrong decision at the wrong time, you probably don't realize it, but that's not really advisor's job. It's completely different. That's why you see that variance. If we go back here, the index on the 20-year was 5.62, you're at 288. You're getting half the index because you're making bad decisions at the wrong time. And again, as we talked about, stocks and real estate, it's been different. Housing never used to be able to compete from a growth standpoint. That's not what housing did. Well, that's changed. And that's where we have to realize that this is a very, very interesting asset class for retirement. Okay, so when I go through this, a lot of people say, yeah, but you're cherry picking 2000, that was a bad decade. So let's run it at 8%, right? We just said over the last 20 years, you only got 2.88, but okay, let's run it at 8. So that 200,000 grows to 634. Same scenario, our homes are paid off. You're still only generating $17,000 in income based on that 2.8% number, right? So it's borderline impossible. Well, it's not. Here's the number you need. You need a 22% return for 15 years. You need this thing to grow to 3.7, that 200 go to 3.7. The best private equity firms struggle to get 22%. That number is not realistic for the average investor. That's how powerful buying real estate the right way is from an income generation. It's really hard for Wall Street to compete against. Here are the objections that we hear, right? Because a lot of people get to this point like, okay, I like it. That makes sense. Yeah, I'd like to diversify. I can see how it can increase income, but I don't want to be a landlord. What if it's vacant? What if it needs repairs? I love the illiquid asset. It's so funny because advisors use this a lot, but they want you at 30, 35 to lock money up for 20 plus years into an IRA. The fact of the matter is it's not a illiquid asset. Doesn't mean you can get daily liquidity, but it's not illiquid. There's obviously a market for it. But at the end of the day, it's who's benefit? Who's giving you this information, right? It's usually financial professionals. They're competing, not want you to buy real estate. But I will say the landlord is a very credible objection. Most people don't want to be a landlord. But what we say, why would you want to be a landlord, right? So what we've included in the Retirement Income Accelerator is a property manager, a full-fledged property manager. They can help assess renovations. If you're buying the property, they do all of the billing, credit checks, all that stuff. So you get a full-service property manager, and that's included in any property that you might be looking at. So we'll run our assessment and include the property manager. Now, you don't have to use the property manager, but the property manager is very, very cost effective, and it literally removes all the hassles that come with buying rental properties. We've talked about income, but also predictability of income, I think, is really important too, right? You have no control when it comes to stock and bond performance, right? We talked about that slide earlier with the sequence of returns. The nice thing with real estate is, as we mentioned, you have a copy of the amortization schedule. So you know, hey, every year my principal's going down. This is how much closer I am to paying this off. And then I'm going to really maximize retirement. So it does give you more predictability from an income, from the amortization schedule, knowing where that income is going to be. So we do think that's also helpful. That and it also provides you more control, obviously, because it is independent of the stock market. So here's the advantages that we see with our Retirement Income Accelerator. As we showed on the slides, you're going to significantly increase your retirement income. You're going to create income that's independent of the financial markets. So that's very helpful. You're going to create income that's what we would deem highly predictable. The potential to reduce taxes in retirement, take more control over your success, right? You're not at the mercy of the markets. And this can be passed down almost, again, you're creating a business, right? So you can create an income stream for your children or grandchildren if you want. So there's a lot of advantages from the income accelerator. So if you'd like to learn more about how this potentially could fit into your overall retirement plan, we're offering a free 30-minute strategy session with us. Feel free to contact. Here's my contact information. We can give you a little bit more information about the 3 strategies to create huge tax deductions, which I know that's what most people are interested in, and answer any questions you might have. So we really appreciate the time and watching this long. I hope you found it useful, and we will talk to you soon.